Advisors Asset Management offers a suite of innovative ETFs to help investors meet their income and capital appreciation goals. Visit aamlive.com/ETF for more information.
Welcome to Exchange Traded Fridays, a weekly podcast looking inside the world of ETFs from our unique vantage point here at ETF.com. I'm Jeff Benjamin, Wealth Management Editor, and I'm joined by Senior ETF Analyst Sumeet Roy, Research Lead Kent Tooney, and ETF Reporter DJ Shaw. This week we're talking about this new Defiance ETF that DJ wrote about, which is counterintuitively stripping the Magnificent Seven stocks out of the index. We'll be hearing about that from DJ. Then there's this mysteriously popular iShares 20-plus year Treasury Bond ETF, TLT, that continues to attract money as it continues to lose money, at least this year. And we'll wrap up with my conversation with Lance McGray of Advisors Asset Management to talk about where preferred stocks might fit inside a diversified portfolio at this point in the market. How you guys doing?
Doing great. How are you?
All right, everybody good. DJ, this was kind of interesting. We talked about it in the newsroom. This company Defiance coming out with an ETF that is stripping the Magnificent Seven stocks. The seven stocks have been basically carrying the market for a couple of years now. It's where everybody wants their money to be. They make up a majority share of the S&P 500, the broad market indexes. And I guess somebody came up with the idea of taking that rocket booster out of the index. What actually happened there?
Yes. So this ETF from Defiance launched Tuesday, and it's essentially an anti-Magnificent Seven ETF. So it essentially gives investors the S&P minus the seven mega cap tech companies that really make up 33% of the S&P 500. So basically, this ETF starts with the largest 700 stocks and selects the top 500 by market cap and removes Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. And like I said, this ETF is basically the opposite of what MAGS does.
Yeah.
Which only holds the top seven.
Yeah, stocks. MAGS, it's Round Hill Magnificent 7 ETF. The ticker is MAGS. That is up over 40% year to date and 59% over the past 12 months. And these are the stocks that they're taking out, right?
So those are the stocks that they're taking out. And, I was reading a story, and the Defiant CEO, Sylvia Jablonski, kind of made an important point about why they launched the funds. And she said many investors might not realize how much exposure they already have to the seven Mag 7 stocks through their other holdings. So
that's a really good point. Yeah. I mean, you're right. If you've got any kind of broad market exposure, you've got a lot of that stuff. Sumeet, how would you kind of analyze this ETF in the context of what's out there in the market? I mean, I think there are funds, there are equal weighted strategies out there. I think RSP is the equal weighted S&P 500, which dilutes some of that Mag 7 exposure. But what do you think about just completely removing it?
Yeah, it's interesting, Jeff, and it's kind of interesting timing as well. We're recording this on Thursday, and one of the Mag 7 components, Tesla, is up 20% just today. And if you look at the contribution that single stock is having on the S&P 500 today, it's essentially 25 basis points of return for the S&P 500 because Tesla makes up around 1.2% of the index. And XMAG, which is the ETF we're talking about, obviously does not have Tesla, so it's not benefiting from that 20% surge. So we're seeing something like SPY up, 0.25% on the day as I'm speaking, while XMAG is actually down on the day. So that's kind of, illustrates, the downside of not having exposure to these stocks. And this has been the case for as long as these, mega cap Mag 7 stocks have been rallying. But like you said, there's been some demand from some parts of the investment world to kind of exclude these stocks because maybe they're too expensive or there's just too much risk having, so much of your index exposure in just these handful of stocks, right? I wrote about RSP, which you mentioned earlier this week, and in something like SPY, the S&P 500, the Mag 7 represent 32% of the ETF, or about a third of the ETF, while in something like RSP, it's only 1.5% for all of those seven stocks. So,
Wow.
yeah, I mean, it's a big difference. But, if those, that 30% continues to deliver huge gains, Nvidia's up something like, it's tripled or something like that this year. Meta's up 70% this year. If they continue to deliver like that, then anything that, kind of de-emphasizes these stocks is going to underperform. And, that's what we're seeing with XMAG early in its, history. We've seen that with RSP, that they've been underperforming. But,
Yeah.
you do bring up a good point. If you think that, the Mag 7 are, too high, their valuations are too high, they can't continue to go up like this, how do you position yourself? Do you buy something like XMAG? Do you buy RSP? I think it's interesting because RSP is an option. It's been out there, but you're equal weighting all of the stocks within the S&P 500, right? XMAG is different. You're not equal weighting. All of the stocks are still market weighted. You're just taking out those seven stocks. So, for example, Broadcom, that's a massive tech stock. It's gone up a lot this year. It's an AI play. It's worth $800 billion, I think, in market cap. That would have a very small weighting in RSP, just like all the holdings. They're equally weighted, 0.2%. But in XMAG, it would actually have a big weighting because it's a huge company, but it's not one of the Mag 7. So it'd still be in the portfolio at a big weight. So that's what makes this a little bit different than RSP. You're still going to get exposure to big stocks, just not the Mag 7.
I didn't even think about that. What is the largest company in the XMAG? Do you guys, anybody know?
That's
Market
a great
cap
point.
wise?
I'm going to look that up right now
Okay.
as you guys keep
Well,
talking.
let me ask Ken a question while you're looking that up, Samit. Ken, you're a big picture guy, a portfolio management guy. I mean, do you see this as kind of a, the Defiance ETF going after people that are maybe trying to get a little bit ahead of the pullback, if there is one in the top of this Mag 7 run?
Yes, I mean that's a short answer. I mean, if I'm putting my ETF issuer hat on, I'm thinking about okay, and this is also a great thing about or spotlights the innovation of ETFs. Okay, what do investors want, or what do I think they're going to want? So yeah, you're right, Jeff. I mean, I see investors and a lot of the little groups that I go in and I talk to other advisors and other investors and analysts and traders and all that. There's a growing concern about the valuations of the Mag 7 stocks. Now, of course, they can keep going. The momentum can keep on going, and if you carve out the Mag 7, you could end up losing, to the broader benchmarks. So if I put my issuer hat on, I'm thinking, what's the demand and what do investors want? So I'm not thinking about what's going to perform well. I'm thinking about what investors are, what options do they want? There's already signs of rotation out of mega caps into small caps and mid caps, value stocks. So my very short answer would be why not? I mean, it's an idea that no one has done exactly. You talked about RSP, but this is just another option. Hey, I like the S&P 500, but I'm worried about the valuations on the Mag 7. So there's your solution.
Yeah, interesting. Samit, did you get the?
Yeah, I
big...
did, Jeff. And funnily enough, it's Broadcom.
Oh, okay.
3% weighting in the ETF. And that's followed by Eli Lilly, the pharma giant that's big in weight loss drugs, 2.2% weighting there. And then we have JP Morgan, Berkshire Hathaway, and ExxonMobil. So quite a bit different than, something like SPY, where you're going to get the Mag 7 at the top.
Well, I guess that's what makes a market. There's something out there for everyone, and we'll see if this is just kind of a gimmicky thing or if it has legs. I mean, if the Mag 7 for some reason, I don't know how this could happen, but if all seven of them started to hit the deck, there would be an alternative out there for people that want to avoid that. But it seems like if this big heavy thing goes down, it's going to bring down a few things with it. And speaking of going down, TLT, all right, it's a fun ETF to talk about, and we talk about it a lot here at ETF.com. Samit, you wrote about this earlier this week about the big inflows into it. By my latest count, TLT is down. It's a bond fund, so it's not really fair to talk about it in the total return spectrum, but it is down year to date on a total return basis about 4%. But the money keeps going in. Last week, $1.7 billion flowed into this $60 billion ETF. I want you to, Samit, first of all, kind of lay the foundation. I'm going to go to Kent and see what his thoughts are on to me, it's a counterintuitive move. I've said that for more than a year, but
Yeah.
what do they say in that one one book by Lewis? I wasn't wrong, I was early. Well, that's the same thing. So,
Yeah, yeah.
go
I
ahead.
mean, Jeff, yeah, counterintuitive, I think is the right word. And there's just so many things going on in the bond market that are just counterintuitive, right? Like the Fed cut rates on September 18th, I think it was. And TLT price topped out 2 days before that. That means the yields hit their lowest level of the year, essentially at that time. But ever since the Fed cut, it's been straight down for TLT. And now it's given up all of its year-to-date gains. I think it's down 9% since it peaked just on September 16th. You would have never thought that, right? Because the Fed cut rates not too long ago, 50 basis points. But
Mm-hmm.
I mean, the market is forward looking. And at the time when TLT was making its price highs and yields were making their lows, people were thinking, oh, the Fed's going to be very aggressive in cutting. The 50 basis points is just the start. Maybe we'll get even more 50 basis point cuts. But in just a blink of an eye, we get this one strong jobs number for September. And all of a sudden, people are like, okay, the economy's fine. We don't need, accelerated rate cuts. The Fed might keep cutting, but it doesn't have to cut aggressively. And that's the reason why rates have come back up and TLT price has come down. But as I wrote, even though TLT has been coming down, investors just keep putting money into it. I mean, you mentioned the inflows, billions over the past week since the start of the year, I think over $10 billion. And it's just been vacuuming up assets. And I don't think that's necessarily, investors are doing anything wrong there. I think it makes total sense why they're doing it because over 2024, we have seen something very interesting, and that is that the inverse relationship between bonds and stocks has reemerged. Everyone was talking about the death of the 60/40 portfolio, things like
Yeah.
that in 2022, 2023. Bonds and stocks are going down. But now we're seeing the opposite. When recession fears come back into the headlines, we see bonds go up in price, yields go down, and bonds act like the hedge that you want them to act like. So just because the economy's doing well now, stocks are doing well now, doesn't mean that's always going to be the case. So you want to have this kind of portfolio diversifier in your portfolio, something like TLT, that
Mm-hmm.
when the stocks market is going down, recession risks are rising, you can kind of be insulated for that. So I think it's nice, and it makes sense that investors are putting money into TLT even though its price is coming down.
Kent, what are your thoughts on TLT?
My first thought is I'll just add to or support what Samit was just saying. It's easy to ask why invest in TLT, especially when we've seen prices fluctuate up and down. And if you pick certain time frames, sure, year to date is down 4%. But coincidentally, it's been almost exactly 1 year since I wrote an article called "Has TLT Hit a Bottom?" And it turned out that I was right on. Now, I didn't say TLT did hit a bottom. I was just wondering why, because it was at a multi-year low, something like a 2-decade low price, and the volume was really high, which means everyone's in there trading back and forth. But can we guess what the return is or the gain is for the price over the last 1 year? Anyone want to guess?
The total return over the past year?
Yes.
I'm going to say it's probably up 10% or something.
Pretty good guess, 13.6%. So
Okay.
now everyone didn't magically buy, 1 year ago exactly. But to Samit's point, I mean, that's the idea is if you think inflation is going to fall or you think a recession is around the corner, TLT is a great diversifier. And I'm not just preaching that fund, bonds in general. I mean, and it is a great point that Samit makes that everyone was saying 60-40 portfolios is dead, the 60% stocks, 40% bonds, old traditional moderate allocation portfolio. But it can still be a good idea. So TLT, people don't invest in funds like that just because they think they're going to get a big gain. They want to diversify. And that's over the last year, combination of that fund and stocks is doing very well. And also, buying when the share price is lower, if someone's trying to time things or be more of a technical approach, can make sense. And so maybe there's more shares being bought because the investors disagree with the idea that inflation is coming back. So a lot of different ways to look at it.
Yeah. Can any of you guys think of anything that's in recent memory that's similar to the TLT phenomenon? I'm just completely fascinated by it. It's kind of the opposite of what retail investors always get blamed for. It's not chasing performance.
Yeah, it's a great question, actually, Jeff, and I can't think of anything off the top of my head. We have seen times when investors rush into asset classes and ETFs that have fallen significantly in price, hoping for a rebound. Like we've seen that with oil, during COVID when the Jets ETF tanked because all the flights got canceled. People piled into that.
Yeah.
But obviously that is another extreme, right? People are trying to catch the falling knife. We usually see people pile in when things are going up as well. Maybe JEPI is something like that. I mean, we've seen huge inflows into JEPI over the past couple of years, but the performance hasn't been that great, to be honest. It's underperformed the S&P. Hasn't done that great from a performance perspective, but the demand has been huge.
Yeah, that's a good example. That's another one that in a future podcast maybe we gotta pick apart a little bit. Another ETF that I'm fascinated with, but right now I'm going to bring in Lance McGray, Managing Director, Head of ETF Product at Advisors Asset Management. How you doing, Lance?
I'm doing well, Jeff. Thanks for having me.
Yeah, thank you for being here. I want to hear about what you got going on in the preferred stock category. Let's start off by speaking to some of the fears facing investors in this market: inflation, interest rates, maybe some volatility. How can investors find some comfort within the preferred stock asset class?
Yeah, I think, when we talk about the current market environment, there's certainly a lot of uncertainty out there. And, obviously, as your listeners know, this uncertainty creates a lot of volatility. It creates a lot of, investors doubting themselves, figuring out where they should invest, what the best options are in the marketplace. We obviously have a tremendous amount of unknowns out there, right? Not even just talking about inflation and interest rates. We have a number of geopolitical events out there. We have an upcoming presidential election. So again, there's so many different variables out there. And to your point, one of the areas that we think is quite, underutilized or overlooked is the preferred stock market. And we think there's a lot of reasons that, investors should be looking in this area of this asset class or this market because it provides a lot of potential benefits to investors, specifically, those investors that are looking for income. But it also has the ability to offer diversification. And, quite honestly, another big benefit of the asset class is tax advantaged income, right? And that's something that everybody's looking for the most part. So again, this is an area that's often overlooked. People fail to realize how big the market is. The U.S. ETF preferred market right now is over $40 billion in assets. And it's an area that I think a lot of investors could be looking at to ease some of their minds in these uncertain times.
What are some of the risks associated with this asset class?
Well, just like most asset classes, all asset classes for that matter, there's a tremendous amount of risk, right? I mean, obviously, loss of capital. But when you talk about these securities, and again, it's probably worthwhile just mentioning to the listeners, what are hybrid securities? We talk to many financial advisors, they kind of fall in two camps, right? One is the investor, the financial advisor that really utilizes the preferred market, understands the nuances. And then the other is, the investor that doesn't really understand the market, has never really either dabbled in or invested in preferred stock. And to some extent, there's a big education piece that needs to be had. But for the sake of this call, to keep it high level, preferred stocks, these are hybrid securities, right? They have features of both bonds and stocks. And for that reason, there's risks associated with this asset class. Most notably, credit risk, right? Is the issuer worthy? Can they pay the dividends of these? But some of the additional risk that people don't really think about is duration risk. And that's something that comes up, has come up over the last 4 or 5 years as interest rates have been moving, is that these are perpetual securities. And because they're perpetual securities, they carry a tremendous amount of interest rate or duration risk. And then lastly, I'd say call risk. These securities, many of them have call features, embedded options. And for that reason, like some other debt instruments, there are call features that need to be monitored as well. So definitely some risks associated with this asset class.
Okay. Let's talk about the Advisors Asset Management has a rather unique preferred stock ETF offering, ticker PFLD. Can you explain what PFLD is and why it's been so well received?
Yeah, PFLD is really, to be honest with you, it's a product that has really grown up over the years. As somebody that's been in the ETF industry almost 20 years now, has had my hands on well over 70 ETF launches. I can honestly say it never gets old watching a product come from an idea and then be implemented and then see organic growth in terms of assets under management. And I think this is a rather unique solution. It's one that we created back in end of 2018, 2019 with the concept that there's nearly $30 billion at the time, or $30 billion in preferred assets in the ETF marketplace. And those investors, they really didn't understand the duration risk of this asset class. And we had a good feeling that interest rates were going to be moving higher. As we saw, interest rates were pegged around 0 when we launched this product. And over the years, the 10-year creeped up over 4%. And the owners of preferred stocks, specifically the ETFs, really felt the impact of that exposure to interest rates. And this is a product that we designed in partnership with ICE. We launched an underlying index in partnership with ICE, and it's a product that looks to sort of put guardrails on the preferred stock asset class. And what I mean by that is we take two of the more well-known risks associated with the preferred market, right? The call risk and the duration risk. And we kind of put guardrails on it, right? So this is a rules-based strategy. And it's really important to understand, while this is rules-based, you and your listeners, I think understand the difference between rules-based and traditional beta solutions. This is not a beta solution. This is a product that has a lot of features built in that are active, that try to replicate what an active manager would do. And just a couple of the screens would be, we remove securities that have an effective duration of 5 years or more. And that's really important when we try to mitigate the duration risk in this portfolio. And then we also mitigate the call risk. Again, as interest rates move, specifically lower, issuers have the ability to call these securities, generally at par. And unfortunately, if that happens, the shareholder can see unrealized gains disappear rather quickly. So by removing securities that are traded north of 105% of face value in this strategy, we're able to minimize the impact of call risk. So again, this product, to your point, it's gaining a lot of steam. We're on our way to $500 million in assets. We haven't had one month of net outflows. And since September, the beginning of September, we've seen, I think, over 28 days of net inflow. So it's really starting to pick up steam. It's a product that's really timely. It's a solution that I think can help many income-seeking investors try to get the diversification they're looking for, get the potential for upside appreciation, as well as the tax benefits of the ETF wrapper and the preferred asset class.
Okay, you mentioned guardrails a couple of times. When I hear guardrails, people appreciate that in the downside, but does that also come with an upside cap?
Well, and when I say guardrails, what I'm referring to really is the two major screening criterias that we have embedded in PFLD's underlying index. As I mentioned, the two major risks that we try to mitigate in PFLD's strategy is duration risk and call risk. And if you think about these two risks and the two sort of the quote unquote guardrails that we include, right? Removing securities that have an effective duration of greater than 5 years, and then also removing securities that are trading greater than 105% of face value. These kind of they interact with each other in that when one is beneficial, the other is sort of sitting on the sidelines, and when one is sort of front and center, the other is on the sidelines. And to sort of explain that, potentially clearer for the listeners is, if interest rates go up, obviously, duration is going to be key. But as interest rates go down and issuers have the ability or more likely to call securities, that's really where the call screen comes into play. So again, PFLD is not really a play on interest rates or call screens or call risk. It's really a way to gain access to this asset class in a much less risky way, right? For example, if we look at purely through the duration lens, the longer broad-based preferred index right now has a duration greater than 6 years. But if you look at PFLD, we're right around 1.5 years. So you're getting a substantial reduction in duration risk, but you're getting the same benefits of the asset class, the high yield, right? The SEC yield of PFLD is 6.44 currently. You get the diversification, you get the sector diversification, and you get the tax benefits as well.
Okay. Let me ask you about duration with regard to this fund. Rates are likely coming down. Why would an investor look to low duration preferreds instead of a strategy with a longer duration?
Yeah, that's a question that we get quite a bit. And it's one that, to my point earlier, is that PFLD, probably in our opinion, should not be viewed as a play on interest rates because of the two screens that we have, right? The duration screen and the call risk screen. But we get a lot of folks saying, well, what happens if interest rates go down, right? Should I be extending the duration? And the point that we try to make with investors and we ask them is, why are you holding this asset class? What is your intention? Is your intention to recoup or gain capital gains or capital appreciation? Or are you looking to provide some stability in your portfolio? Are you looking to, provide those elevated levels of income, right? Getting the tax benefits again. And one thing we didn't mention is that most preferred stocks offer QDI. So from a distribution standpoint, they're very tax efficient.
Wait, QDI, what is that?
Qualified dividend income. And
Okay.
this is really important for income-seeking investors because the reason why this is so important when it comes to preferred stocks is because right now, or at least last year, PFLD had a QDI of about 75%. And what that means is the income that's getting generated off of this product, PFLD, is taxed at long-term capital gains rate instead of ordinary income. So if you're an income investor in a taxable account, the income that's getting generated from this solution can be very, very beneficial from a tax perspective versus an ordinary debt product. So that's also a very big talking point. But getting back to the duration and the use of PFLD as interest rates are going down, we think of it as an evergreen solution, right? It's a way to we think of it as this way to gain exposure to a rather risky asset class in a less risky way. And lastly, I would say is when we think about what's going to happen going forward, right? If we look at sort of the yield curve, 1 year forward, what we expect to happen is interest rates to come down in the shorter end of the yield curve. And what that means is most likely is that we're going to have elevated levels of volatility there as well. And I think that's one area where PFLD and its, currently its lower duration and impact on that part of the yield curve is really going to play really well for those investors that are looking to mitigate interest rate risk and interest rate volatility, while also getting, certainly a very healthy income level in terms of distributions.
All right. Well, Lance, I learned a lot. Preferred stocks. I'll be keeping an eye on preferreds and this particular ETF, PFLD. Want to thank Lance McGray from Advisors Asset Management. And on behalf of my colleagues Samit, Kent, and DJ, I want to thank you all for listening. Don't forget to check out ETF.com to see all the great stuff we've got going on there these days, including the Advisor Center, which is designed specifically by and for financial advisors. Until next time, thanks for listening.